A brand new water heater runs about $1,400 installed. The home warranty plan sitting in your kitchen drawer, the one you paid $550 a year for, will pay out roughly $500 toward that replacement, and the paperwork is written so that this counts as the plan working exactly as intended. That's not a glitch in the system, that's the system. Home warranty companies get talked about like they're insurance for your house. They're not, and the distinction matters more than almost anyone realizes when they're signing at closing. What you're actually buying is a service contract with a hard ceiling on every single payout, a list of exclusions long enough to disqualify half of what actually breaks in an American home, and a fee structure designed so the company profits whether or not your air conditioner ever gets fixed. The appliances are almost beside the point. The real product is the gap between what you think you're covered for and what the contract actually promises, and that gap is where the entire business lives. Let's start with how these plans usually show up in your life in the first place, because that's not an accident either. A huge share of home warranty enrollments happen at two moments: when a house closes and when a TV ad promises peace of mind during a commercial break. At closing, it's often framed as a gift from the seller or the real estate agent, a one-year plan bundled into the deal to smooth over any anxiety about the aging furnace or the 12-year-old dishwasher. That first year is frequently free or heavily discounted to the seller, sometimes costing them $300 to $400. But real estate agents in many states can receive a referral fee for recommending a specific warranty company, something in the range of $15 to $25 per policy, sometimes more depending on the brand and the state's disclosure rules. It's a small number per transaction, but multiplied across an agent doing 40 or 50 closings a year, it adds up to a quiet, steady revenue stream that has nothing to do with whether your dishwasher ever breaks. That first year is also, not coincidentally, the cheapest one you'll ever pay, because here's the part that changes how you read the whole relationship. Home warranties renew automatically, and the renewal price almost never matches the introductory price. A plan that started at $350 in year one commonly renews closer to $550 or $600 in year two, and it keeps climbing from there, sometimes $700, $800 a year by year 3 or 4, especially if you filed a claim or two. Most people don't shop it against competitors every single year. They just let the credit card get charged, the same way people let a gym membership or a streaming bundle ride for years past the point they're actually using it. Now let's talk about what happens the moment something actually breaks, because this is where the real mechanics show up. You call the warranty company. They don't send their own repair person, they dispatch a contractor from their network, and you pay a service call fee, typically somewhere between $75 and $125, just for someone to show up and diagnose the problem. That fee is due regardless of what the contractor finds. If the fix turns out to be excluded from your coverage, which happens more often than the marketing suggests, you've still paid the service fee, and now you're also paying out of pocket for the actual repair. And this is where the exclusion language starts doing the heaviest lifting in the entire business model. Almost every contract has a clause for pre-existing conditions, which sounds reasonable until you realize the contractor doing the inspection works for a network paid by the warranty company, not by you. If they determine the issue existed, even partially, before your coverage started, corrosion that built up over years, a slow leak, wear that predates the policy by even a few months, the claim can be denied. There's also language around improper maintenance, which can cover anything from not changing an HVAC filter on schedule to not having service records to prove you did. And there's the secondary damage exclusion, meaning if a leaking pipe causes water damage to your floor, the warranty might cover the pipe but explicitly not the floor, the drywall, or the mold remediation that follows. Independent estimates and state consumer complaint data suggest claim denial rates for home warranty companies commonly land somewhere between 20 and 40%, depending on the company and the category of system involved. That's not a rounding error. That's a meaningful share of the people who file a claim in good faith, pay their service fee, and walk away with nothing covered. But here's the mechanism that's even more interesting than denial, because it explains what happens on the claims that do get approved, the payout caps. Most plans list a maximum dollar amount per system, per contract year, buried in the fine print. Air conditioning might be capped around $1,500. A water heater might cap around $500. A garage door opener might cap around $250. These numbers sound reasonable in isolation until you compare them to what those systems actually cost to replace in 2026. A mid-size central air unit replacement in most of the country runs between $5,000 and $8,000 installed. If your unit needs full replacement rather than a patch repair, the warranty covers a fraction of the bill and you're responsible for the rest, while still having paid the annual premium and the service call fee to get there. This is where the contractor network becomes the quiet engine of the whole thing. Contractors in these networks are typically paid a flat, often discounted rate by the warranty company for each job, well below what they'd charge a homeowner paying directly out of pocket. That creates a financial incentive, structurally, not personally, for contractors to patch rather than replace whenever a patch is defensible. A cheap part swap keeps the job profitable for the contractor at the discounted rate. A full system replacement often isn't, because the payout cap means the warranty company won't authorize the full cost anyway. So the system gets a temporary fix. Then, 6 months later, it breaks again. You call again. You pay another service fee, another $75 to $125 for a problem that, in a lot of cases, was never fully resolved the first time. From the company's side, that's not a failure. That's a second service fee on the same underlying issue, and depending on the plan, it might even be a stronger claim for them to deny under the pre-existing condition language the second time around. Add that up across a large enough customer base, and you start to see the actual profit engine. It's built on 3 layers stacking on top of each other. The annual premium, which is collected up front whether or not anything ever breaks. The per-visit service fee, which is collected every single time a contractor is dispatched, claim approved or not. And the payout cap, which limits the company's maximum exposure on any approved claim regardless of the real replacement cost. Insurance companies call this a loss ratio, the percentage of premium dollars that actually goes back out the door as claims paid. Publicly available filings and industry analyses have put home warranty loss ratios in a range roughly between 40 and 55%. Meaning for every dollar collected in premiums, something like 45 to 60 cents stays with the company and its network before a single claim dollar is spent to fix anything. Compare that to traditional homeowners insurance, which in most states is required to maintain loss ratios much closer to 60 to 70% or higher, because insurance is regulated at the state level with reserve requirements, rate filings, and oversight boards built specifically to protect policyholders. Home warranty companies in most states are regulated as service contract providers, not as insurance. That's a real, meaningful legal distinction. It's the reason the marketing can describe coverage and protection in language that sounds like insurance, while operating under a far lighter regulatory structure with fewer requirements on reserves, fewer restrictions on denial practices, and far more flexibility in how exclusions get written into the fine print. None of this means every claim gets denied, or that the industry is fabricating problems. Plenty of people file a straightforward claim on a straightforward appliance failure, a dishwasher motor, an oven igniter, and it gets approved without drama. The technician shows up, the part gets replaced, and the whole experience costs less than paying for the repair directly. That does happen regularly. The plans work best, statistically, for people with a cluster of aging but not ancient appliances. Systems old enough to be failure-prone but not so old they trip the pre-existing condition language, and not so new that a manufacturer's warranty already covers them for free. That's a narrower window than the marketing implies, but it's a real window, and for buyers who land inside it, the math can genuinely favor the customer in a given year. Here's who this really doesn't work well for. People with a brand new home where systems are already under builder or manufacturer warranty, meaning the home warranty is paying to duplicate coverage that already exists for free. And it doesn't work well for people with very old infrastructure, a 50-year-old furnace, ancient galvanized plumbing, because that's exactly the profile most likely to trigger a pre-existing condition denial, or hit a payout cap that barely dents the real replacement cost. The plans are underwritten, in effect, for the statistical middle, houses just old enough to worry about, not old enough to be a guaranteed loss for the company writing the contract. There's one more layer worth naming, because it shapes the whole customer experience even when nothing is technically wrong with the contract. Friction. Filing a claim usually means calling a number, waiting for a callback window, sometimes a same-day appointment, sometimes a multi-day wait depending on contractor availability in your area, and then waiting again for the contractor's diagnosis to get authorized by the company before any repair actually happens. Every extra step is also an extra moment where a customer might just give up, pay for the repair themselves, and let the claim quietly disappear. An industry doesn't need to deny every claim outright to improve its numbers. It just needs enough friction that a meaningful percentage of eligible customers never finish the process. That's not a conspiracy. It's closer to how any subscription business with a redemption step behaves. The same dynamic that shows up in unused gym visits or unredeemed store credit, just wearing a different uniform. So when you zoom all the way out, the picture becomes pretty clear. The premium is collected up front, guaranteed, every single customer, every single year, whether their water heater fails or not. The service fee is collected on every dispatch, approved claim or denied one. The payout is capped no matter how expensive the real repair turns out to be. And the network of contractors doing the actual work is financially nudged toward the cheapest defensible fix rather than the most permanent one, which quietly manufactures the next service call down the road. Every piece of that structure can be true at the same time that a real customer on a real Tuesday gets a real oven fixed for less than it would have cost out of pocket. Both things exist inside the same business. The company just isn't betting on your appliances failing exactly like an insurer bets on a house burning down. It's betting on the spread between what people assume covered means and what the 11 pages of exclusions actually say. And that spread is where the real profit sits, quietly, year after year, long after the closing gift has been forgotten. If breaking down how the everyday businesses around you actually make their money is the kind of thing you want more of, subscribe so the next one lands in your feed. And if this changes how you'll read your next home warranty renewal notice, tap like so it reaches someone else before